All right, Dinshaw Irani joins us now. Dinshaw, good morning. Thank you for joining us. I'm tempted to start with what is happening in the IPO market. Nika opens today, Paytm opens very soon, and then you got Policy Bazaar. What should we start with? The dhamal in the IPO market, because these are good companies, relevant companies, interesting companies which are going public.
Thank you, Nikunj. Always a pleasure to be on your show, and a very good morning to you and your viewers. On the IPO front, Nikunj, I mean, all these businesses are phenomenal. I mean, if you look at what's going to happen in the future, these are all prime for the future. But then, when you're looking at that, you also have to keep some, valuations in mind. I think most of these guys are coming at valuations which won't leave much on the table for IPO investor. Forget when the listing happens. So maybe when the listing happens, maybe that is when you're supposed to reevaluate these businesses and look back and say, hey, am I comfortable in giving this kind of value for a business which is going to fructify in the next 4 or 5 years or so? Well, that's a call which is left to each individual investor. But we believe that at the time of, whenever the listing happens, that's when the real the real juice will be taken out from the thing as such. So be cautious here. I mean, IPO price probably is a good price, but then they'll be massively oversubscribed. So I don't know how much the investor will get. So businesses are good, as I said, for future, prime for future. So that way.
If one looks at Zomato, and I'm spending some time, Dinshaw, around it. Why? Because this is something which I'm sure our viewers would like to understand your thoughts, and I promise I'll come back to the markets in terms of the secondary market. Dinshaw, when Zomato went public, the same naysayers said, look, it's expensive. The market cap of Zomato is more than the market cap of the entire QSR market in India. The market cap of Zomato is something which will not sustain. But the stock is beautifully sustaining. Even though we've seen a sizable correction in the so-called good quality expensive stocks, Zomato is still holding on.
Yeah, so I think most of the other IPOs which came after Zomato, by the way, we were subscribers in the IPO and we made a fair bit of money there. But after that, whichever IPO has come in, this new sectors, which are, e-commerce or whatever you want to put them as, a fintechs and stuff, they realize looking at Zomato that you don't want to leave much on the table for your investors. So all these guys are coming at valuations which are more or less, will leave around 15-20% for the investor at the time of listing per se. But apart from that, that's what I felt that that's a house view actually, that it's better to be in the IPO than in the market when the pricing lists. So you wait it out and then see how the price movement is. So IPO is a good time to enter these stocks, but on the listing bit, I think one has to wait for the listing to happen and then decide whether one wants to continue with this holding or one wants to buy afresh. I think that's a call that will be taken there, but yeah, leave it there.
Okay. So, Dinshaw, ultimately investing is about buying growth. You're getting a 15% growth in consumer companies at a P of 50 to 70 times. You're getting a promise of a 15% growth in other sectors like cyclicals and industrials at a P multiple of 25 times. What is a better strategy?
Yeah, good you asked me that, Nikunj. So in consumers per se, there are two halves after this quarter results which came out. One half is the one where they couldn't pass on the inflated commodity prices or input costs, couldn't be passed on to the consumer. And they were clearly in the space of big ticket discretionary or items, and in the case of FMCGs, which is the lower rung of this, because they play on small ticket items. The ones surprisingly which could pass on were the medium ones, the consumer discretionary, durable small ticket consumer discretionary or durable plays, which were able to pass on. So that was an eye opener for us that okay, it's the regular bread and butter kind of a thing is not moving much. So is the big ticket items, and the middle ones are the ones which are really moving. You talked about cyclicals. I think these are the ones which are creating the inflation in the market today. As in the input price guys who are creating the inflation. But in the case of metals per se, we were very apprehensive earlier because we thought there was a cyclical industry and it didn't work out that way. I think it's more of a structural call here in metals now from here on. So we believe that going forward, these are the sectors you want to be in where the valuations are reasonable, and the fact that there are more a structural pay on the demand hike which has happened. So normally in a cyclical, what happens is the demand increase is followed by a step up in capacity. But here it's not working out because of issues with China in particular, and where you're not seeing these step up in capacities happening. So we believe that this capacity step ups are going to be more staggered as compared to the past when it happened, and mothball capacities will not come online for a very long time. So that's why we believe that this is a more structural play, and as you rightly put it, I think those are the ones you want to be in as such. So I'll go with the cyclicals as you put it, but selectively in that segment, not across the board.
Good morning, Dinshaw. What we've also seen of late is the comeback of the banking sector, how the bank Nifty's outperformed the Nifty. But even when you look at the earnings, blockbuster performance by ICICI. Today, IndusInd Bank is being rewarded handsomely by the markets as well. The comeback of the retail loan book as well. How can one play this theme?
I think the best way to play this is go with the private banks as such, because they are the ones, sorry, they are the ones who are more retail focused than the public sector guys. And we've been doing this. I mean, we very clear that private sector banks are the way forward from here on, because not only of the retail book, but also on the focus on how they service the client, and as a result, how efficient they are in this manner. I mean, if you see the NIMs and everything, whichever banks has announced, I mean, it's all already gone up for them as such. They manage their book very well. And frankly, I mean, we've been saying this all along that if you're looking at the economy growing, it'll grow via consumption. Okay. And when you talk about a 5 trillion economy next 6-7 years, you're talking about consumption driven economy as such. And these private sector banks are the ones who are the real ones who are the retail facing banks as such, and they will drive this consumption. They will fund this consumption rather as such. And obviously, I mean, one derivative of this is again, non-banking finance companies who are consumer facing. I think that is another area that one should look at. So these are the two major heavyweights in our portfolio also. As such, so.
What about auto? You know, we started hearing a lot of commentary on it's time to maybe go overweight on auto. Maruti came out with this numbers yesterday. It's an earnings disappointment. However, the stock saw a spike because maybe it's being seen as the worst is behind, even though there's some EPS downgrades have come. On the other hand, you've got someone like Tata Motors, which is about having a new platform for EVs and massive TPG deal.
Yeah, so autos actually is again, our belief is that EVs is going to be a big disruptor in autos going forward, especially in the two-wheeler space. Two-wheeler is already, I think, more or less, you've seen the disruption happening in a big way in the two-wheeler space. But in the PV space, I think it'll be spaced out a bit. Obviously, the existing players will be looking at EVs going forward, and they are already, as you mentioned about Tata Motors, but it's a very small segment for them today. As such, though, it's a very big one for India put together. But the fact is that in the EV space, there'll be more players coming in. It's not that only the auto manufacturers will graduate to EVs. There'll be new players coming in, and there'll be a lot of disruption happening out here. Unfortunately, the chip shortage hit the EV space at the wrong time, because this was the time when they could have, produced more IC engines and stuff like that. So because we believe that by probably just after the middle of this decade, EVs will outsell ICs. So that will be a big negative for them as such going forward. So we are very cautious here. Don't forget that the world has anointed Elon Musk as the next disruptor by choosing him as the richest man in the world as such. So it's obvious that, and look at the earlier richest people who were there, they were all disruptors in their own fields as such. So it's obvious that the world is looking at EVs in a big way, and that is what is giving us a caution going forward on the PV space. We like structurally long-term stories. We don't think that structural play is there in PVs today. Maybe you can play a blip here and there, but on a longer-term basis, it's not going to work out for them. It's going to be a very messy market going forward for PVs.
It is going to be. Dinshaw, you just alluded to, your views on the earnings pressure led by commodity. While clearly some of the consumer companies have managed to, handle themselves and pass on the cost to the consumers up until now. But the aspect that I wanted to understand was, when does the central bank break the trajectory? From when do you see them move on from a growth propeller to an inflation warrior? And if that were to happen, could that really be the turning point in that sense for the markets? And could it really spook the markets, a potential pause in rates, or for that matter, the trajectory getting changed to rate hikes, for that matter?
So Aisha, couple of things out here. You just asked about the rates, but how it will impact the market, and it's going to be a few ways, right? So one obvious one is that COVID per se, when it came in, it makes the central bankers very resilient towards these spikes in inflation or in growth as such, because they were very clear that they wanted to do these, the rate hikes or tapering to happen only as and when stability kicks into the market. So I think that resilience has been tested to the hilt for most of the bankers. Again, this inflation is not an India specific event, it's a global event. So we believe, it's a house belief, that whenever this tapering happens, or when the interest rate strikes start happening, it's going to be a global event. It's not going to be driven by one single banker who decides, okay, enough is enough, maybe a few here and there, but otherwise it will be a global event. Secondly, in terms of discounting, let's understand that the markets today are at high multiples mainly because interest rates are at low levels, right? And that's how it is, right? Or it works vice versa. If the interest rates are high, the multiples are low. Okay, so that is what happened. Another thing that has helped these low interest rates is that the balance sheets of India Inc. has become stronger. Today, if anything, they came out of this COVID in a very strong way by repaying their debts and having a lot of cash in their books as such. And what happened was that the debt equity today is at an all-time low. So obviously, when you're looking at a strong balance sheet, you always pay a higher multiple for a strong balance sheet. Yeah, that's what happened in the case of India. In fact, that's what we believe, that the markets are at fair valuations today, given the level of interest rates that they are. The third thing that you should look at is that if these rates are hiked in a very gradual manner, again, I said that if you look at the balance sheet, they're strong, right? So already at low debt equities. So a hike in interest rates in a gradual manner may not impact these balance sheets in such a big manner. In fact, just to share another figure, the enterprise value to free cash flow today is at a 20-year flat line. It's not moved up much. It's in fact slightly lower than the 20-year average that you've seen. In fact, if you had seen the peak of 2008 when the markets were rallying like mad, I think that time, I'm talking about Feb 2008. In fact, it's like 40-50% lower than those levels. So it's a strong balance sheet we're talking about. So the interest rate hikes may not impact them that much, but it will impact the market sentiment to an extent. But it has to all trickle down to how gradual they are. And I think the bankers have learned their lesson in the past. If you see the Jackson Hole speech, which is last time around, it was riffled with examples of how early tapering or a hike, undue interest hike, affected the markets from 50s onwards to the late 90s per se. So it's obvious that the bankers are also cautious here. So that way.
Yeah, absolutely. Okay, Dinshaw, great to have you in the show as always and get in all that insight. And in case we are unable to meet before Diwali, here's wishing you and your entire team at Helios a very happy Diwali from all of us.
Thank you, and wish you all the same. Thank you.